The importance of Elliott Wave Theory in understanding market structure. Elliott Wave Theory is not merely a method for counting price swings. It is a structural framework for understanding the market at a deeper level. While many technical tools focus on entries and exits, Elliott focuses on a more fundamental question. Where are we within the market structure, and is the current flow still intact or beginning to fracture? The core value of Elliott Wave Theory lies in its ability to describe the market as a fractal system of expansion and contraction. Price does not move randomly. Each movement is part of a larger repeating structure, expressed across multiple time frames. This fractal nature allows traders to interpret not just direction, but structural context. One of the most critical aspects of Elliott analysis is correct wave counting during expansion phases, particularly in Wave 5. Expansion is not simply continuation. It is a phase where market dynamics change. Momentum may accelerate, or price may struggle to advance despite increasing effort. Accurate wave counting allows us to distinguish between a structure that is still flowing and one that is approaching exhaustion or structural failure. This is where Elliott provides a key advantage. It helps differentiate between a true structural break and an internal correction within a valid trend. Not every pullback signals a reversal, and not every new high confirms strength. Elliott Wave Theory offers a structural language to separate healthy continuation from emerging instability. Another crucial dimension of Elliott Wave Theory is its fractal alignment across time frames. Wave counts on lower time frames can often anticipate or reflect the development of higher time frame structures. Micro price movements are not isolated. They aggregate into macro formations. When counted correctly, lower time frame waves can signal how a larger fractal structure is evolving. Because the fractal structure repeats itself, wave counting allows us to assess the overall fractal flow of the market. This provides a powerful perspective. Rather than reacting to price in isolation, we can evaluate whether price action across multiple timeframes remains structurally aligned or is beginning to diverge. When wave structure is well defined, Elliott Wave Theory also enables the identification of price discovery phases. In these conditions, the market operates beyond clear historical reference points. Structure itself becomes the primary guide. Elliott does not predict price levels. It defines structural validity boundaries, beyond which a scenario becomes invalid. Ralph Nelson Elliott defined market movement as a sequence of 5 primary waves, composed of 2 dynamic zigzag-like price diamonds of impulse and correction. While Elliott also studied proportional relationships between waves, including Fibonacci ratios, the primary focus here is not mathematical precision, but structural accuracy. It is essential to state this clearly. Elliott Wave Theory is inherently subjective. On its own, it is insufficient. Without integration with price action, key levels, market context, and risk management, wave counting has little practical value. Elliott's strength lies not in prediction, but in serving as a structural backbone upon which other analytical tools can rest. Used correctly, Elliott Wave Theory does not seek certainty. It seeks clarity of structure. It helps define whether the market remains in flow, where that flow may weaken, and where a genuine change in direction becomes structurally plausible.